You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
All right, everybody. That music can mean only one thing. It is Wednesday, Education Wednesday, as it's known around these parts. And it's time for Options Playbook Radio. If you're saying to yourself, wait a minute, that dude's not supposed to be on this show. You are correct. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting The Options Insider Radio Network. Glad to see so many of you are joining us there on our latest iteration, our latest addition to the network, Options Insider Plus, Options Insider Pro. A lot of you having a ball. A lot of you joining us right now, actually, for this live stream. So if you'd like to get your stuff live in your ear holes immediately, don't wait for the podcast to come, then, of course, Plus is the way to go. If you'd like to go above and beyond, you want to get all the live stuff, and then you want some additional exclusive content, like great pro Q&As. We had a great one this week with Mr. Schlesinger, the short vol legend himself. You want to get, of course, Options Oddities on Friday, and even, of course, that exclusive pro podcast feed. Of course, go pro. You can find out more, theoptionsinsider.com/plus/pro, whatever floats your boat. If you like it after the fact, on demand, you don't mind waiting, you like it on the old podcast form, that's all still there, ready and available for everybody as well. So no matter how you like to consume this content, there's something out there for you. And now it is time, listeners, to introduce the actual host of this show. Yes, the options guy himself, Mr. Brian Overby, a.k.a. the senior options analyst over there at Ally Invest. Mr. Overby, welcome back to your own program, sir.
All right, Mark. Yeah, thanks for hosting. It's been a while since we've done a huddle up to answer some listener questions, so I'm very excited to be back again with you helping me out with some of these questions. So let's huddle up.
It's time to huddle up and answer questions about your favorite options plays. Submit your questions via twitter.com/options, facebook.com/theoptionsinsider, or questions at theoptionsinsider.com.
All right, everybody, here we go. It is huddle time. So a little fun bonus Q&A. If you weren't worn out from our big Q&A earlier this week, you get an extra one with Brian. Brian, this is kind of, let's say this is your trial by fire. If it goes well, maybe we'll look into moving you into one of our full pro Q&A 1 hour slots one of these days. What do you think, sir? Think you can handle all that pressure?
Oh, man, I'm nervous, but I'll try. I'll do my best.
All right. This is just a trial run. We'll ease you in. Actually, an easy way to start, is a topic we were just discussing earlier today on Education Wednesday. Dan and I over there at Options Bootcamp. Seems like people, Brian, these days, not surprisingly, given what's going on out there in the options market, have things like margin on the brain. In particular, a question from Trades with a Z says, can you guys run down how margin requirements are calculated for options traders? I seem to be bumping into that more these days. Thanks a bunch. You guys are the best. We ran down some examples on Options Bootcamp, but Brian, you are an actual brokerage representative, so you deal with this stuff day in and day out over there at Ally. Any insight, any knowledge, any wisdom you want to share here with trades and anyone else who's bumping into some margin issues these days, sir?
Oh, definitely. And I always want to give a disclaimer that, brokerage firms can choose to increase margin on specific underlying stocks. They can choose the way that they're going to treat naked options in their firm. Some of them will maybe have a minimum equity requirement. For example, if you wanted to do a naked call option on a specific stock. So there's no set standard as far as option trading requirements are concerned. But we do have a little website called optionsplaybook.com. And part of our goal when I was writing the book, Options Playbook, is inside the strategies to talk a little bit about margins. So if you have a specific strategy that you're looking at, short call or something a little bit more fancy, maybe like a skip strike butterfly, we'll actually tell you the margin requirement inside the Options Playbook. Now, with that said, most of the time, if you're doing a fancy strategy in general, the margin requirement is going to be the maximum risk. So if I'm paying for an option strategy, in most cases, not all cases, whatever I pay for that strategy is going to be normally my max risk. So there's no additional margin requirement above and beyond. Now, that's in most cases. But if you're doing some more advanced strategies, whatever the risk is above and beyond the debit or maybe credit that I even received is going to be the margin requirement that the brokerage firm is going to want to hold out. So you can run to optionsplaybook.com and you can get the math that's behind that particular strategy. Or one simple thing to do is to use a profit and loss calculator. That always gives you a good idea. If you set up the trade right in a profit and loss calculator, Ally Invest has theirs. A lot of different brokerage firms have a version of it. And whatever you see that maximum loss potential at expiration is, a lot of times that's going to be your margin requirement. That's one of the simplest ways to do it. And it's always good to just toss it into a profit and loss calculator anyways, because you might be surprised what the actual risk is if you start going down that rabbit hole and adding legs to your specific option strategy. So in general, you're going to have to check with your brokerage firm, see if they have any minimum margin, minimum equity requirements. If you're going to do those advanced, very risky trades like a short naked call or a short naked put overall. But then it's fairly straightforward. If you'd like the math behind the actual margin requirements, just go to optionsplaybook.com, click on the strategy, and scroll down to margin requirement.
I like that you take it into account. You could tell you have a history on the brokerage side, Brian, because you put the margin analysis right in there with the trade. It's not the sexiest of things. People don't usually lead with that. But these days, we're getting a lot more questions about this stuff. So I'm glad to see you include it with there. So listeners, check it out, optionsplaybook.com if you haven't already. If you're looking at a specific strategy, chances are maybe Brian's done some of the legwork for you on the margin side. All right, let's keep on rolling, Brian. See how many people we could fit into this movable huddle party here today. Next up, we got Chad. Looks like Chad's actually from down near your area. Chad from Columbia, South Carolina. Maybe he's a neighbor of yours there, Brian. He says, hi, Brian. I have a debit spread on Palantir expiring this coming January. Looks like he's got the 2025. I'm assuming it's a call vertical. He doesn't really say here. Let's pull up Palantir really quick. See where we're hanging out right now out there in Palantir. It's like about 26 and change. 26.36 is where it closed today. So a little bit of an interesting range. Palantir, listeners, one of our top 10 most actives almost every time we do the option block. So a pretty active name. He says, I'm up 42% on it right now. My total cost was $2. So yeah, he's looking pretty good. I'm planning to hold it until around November. I was wondering if I could sell something similar to a covered call on this since I have so much time to expiration. Would you be able to explain how I would go about doing this on your podcast? Thank you, Chad, your neighbor there from South Carolina. So this is an interesting question, Brian. because it kind of combines a bunch of different things. Obviously, we're all glad you're doing well there, Chad. Keep up the good work. But yeah, the notion of selling something covered, he's already got that vertical, Brian, so he's kind of already covered. So if he sells anything else above and beyond that, he's going to kind of be bumping into what we were just talking about, Brian, right? Which is the naked margin requirements, because guess what? He's not covered, Brian.
Yeah, that's very true. So there is no such thing as a covered call strategy that you can leg into when you have a long debit spread. And you do have an issue here because one of the probably what's generated the question is the fact when you go out very far in time and you do a long call spread, or as Chad calls it, a debit spread, a lot of times that trade won't max out until closer to expiration. And so to get to the heart of the issue here is that Chad has bought the 20 strike call that wants the market to go up, but has sold the 25 strike call that really wants the market to go down or at least stay flat, right, overall. So if you're correct on your forecast, the only way that you can max out on this trade is to get some time decay in that 25 strike option contract. So at this point in time, he's been correct on his forecast. I'm looking at Palantir right now, and it's trading above 25. Let's just put it that way. So he's done correct on his forecast, but he's probably just not getting the payout that he was really hoping to get. So he's planning to hold it till November. There's not any great strategy here that we can do. You can kind of roll it into the near term. Sometimes when you get a little closer to expiration, you can actually do the opposite trade, and you can actually sell the debit spread on the put side and kind of create a situation where you have basically no risk, but you're bringing in a fairly decent sized credit from the other side. It would be the synthetic relationship. But now I'm really getting a little bit more advanced here, Mark. Is there any other way that you have in your mind, Mark, that he can kind of lock in some of this profit and still give himself a little bit of upside?
Getting people into boxes now, Brian.
Yeah,
I like it.
That was probably going too far.
That's a little scary. It's funny. It shouldn't be scary. It's more of an institutional play, but we've talked about it on the network not too long ago. Suddenly, even things like boxes are sexy. I think that's probably maybe a bit of a bridge too far. I'm kind of with you on this. That's another thing I kind of wanted to address with this question. I'm not a huge fan. I want to get your thoughts on this of doing a vertical this far out, roughly 6 months out. We see this a lot with people. People come to us, they listen to some of our shows, they learn a little bit about options. Maybe they see something that their broker has educational. They say, hey, I like this. I'm bullish on this name. I don't mind going out a little farther. I want my paying a little bit for it, but I'm going to do this. Now I'm going to do a vertical to maybe mitigate some of that outlay. And so they end up doing these verticals that are 6 months out or longer. And you're right. They don't get any of the bang for the buck that they probably think they would have if they had just done the underlying or just done the call itself outright. I'm much more of a fan. If you're going to do verticals like this, Steven or whoever it is, do it closer to the, you don't have to do it in the weeklies by any means, but within 6 months is definitely a better framework. I would say within 3, maybe out a month or 2, at the outset out there. Give yourself a little bit of time for this stuff to run. But beyond this, now you're kind of stuck in this exact scenario where it kind of went your way, but it really kind of hasn't because you haven't really had all the time decay for the spread to really widen out at max thing. So you're left kind of twiddling your thumbs for the better portion of that spread's life. And there's an opportunity cost to that. Your capital's tied up. You can maybe go do something else. You can't really get the profits that you think you should be or should have or should be entitled to already because your spread hasn't quite caught up to where it needs to be yet. So there's a lot of reasons why doing spreads in this length of time are not my favorite thing. So maybe, Brian, I would probably counsel him, if he's happy with a little bit he's got here, maybe take it off, like you said, and put it on something. I usually don't recommend rolling closer, but in this case, something maybe a little bit closer time frame, maybe in August or September, something like that. You still have a little bit of time for it to run, but also January, he's going to be twiddling his thumbs for the rest of the year, Brian.
Yeah, and that's very true. You're right. Time decay, and this is where once again the profit and loss calculator kind of helps. If you have access to a profit and loss calculator, you're focusing on what's going to happen at expiration, and that profit and loss graph looks wonderful. I'm paying $2, I can make $3 because it was a 5-point wide spread. But if you look at it as of today, you'll see a very flat line in the profit and loss graph, meaning that the good news is here, Chad, that if the market did go down, it's not going to hurt you as much, right? So the market went up, you were correct on your forecast, and now it's not rewarding you as much. But if you were incorrect in this situation, it would have been overall would have been a better scenario, in that you could have closed it out and had a little bit less of a loss overall, because that time value would have helped you. So I agree with Mark, and I know why you're asking that question. Overall, up 42% isn't bad. I understand that you could potentially double this trade, though, if you paid $2 for a 5-point wide spread. And I would just suggest going forward, if I was going to go out to January, I would just think about buying an in-the-money call. And I just talked about that last week. And looking at the ETF, the XLF overall, and just going out further in time and buying a deeper in the money call option, because I'm going to limit my risk still by doing that, but I'm going to get all the upside on it. So if I'm going out further in time, I'd rather just buy calls outright. Now you can decide if you want to go a little bit in the money, a little bit out of the money. It's all about your speculation and what you're thinking that underlying stock will do. But overall, I would rather be in a long call position like we talked about last week in the XLF.
Yeah, this is a fig leaf candidate all day, right, Brian? Do your longer term in the money call. If you want to do near term stuff, you sell the nearer term call against it. Now you have some income portion offsetting the cost of that. It's a much better scenario here. I'm sorry, Chad, that's what it was. Much better scenario, Chad, than kind of twiddling your thumbs until November and hoping something goes on. So you were on the right tip. I see why it's tempting to put these verticals on. I want more time to do it, but as a result, you're going to be waiting, usually, even if it moves your way. And we have a ton of these emails coming in these days. I did something similar in XYZ name. I went farther out. The name exploded or moved aggressively in my direction. Why didn't I get the performance that I was hoping for? And that's one of the main reasons there. So glad it's working out for you, Chad. Maybe you readjust and maybe you try some of those techniques we mentioned there and said, let us know what you do. We're curious here on the show. We want to see how it works out for you. But anyway, glad that you're doing well. Glad that you're making profits. That's what we want for all of our listeners out there. All right, next up, Steven. This came in a while ago, Brian. I think you touched on it on when you did your guest appearance with us on the option block a few weeks ago. But I wanted to make sure he sent it in here, so we should address it here really quickly. It's just Steven. I like the kind of way he calls your book, too. He says, Hi, how are you? I learned so much from the options handbook. Question, why was the short/selling iron condors play excluded? I read many enthusiastic articles about them, but wasn't able to cross-reference and verify them in the options handbook. Is shorting the iron condor a rookie play, as some articles state, or what? Thanks, Steve. So, Brian, maybe clarify him on the actual name of your book. Maybe that's why you couldn't find it. And then B, I do believe you have something in there about iron condors, do you not?
Yes, we do. We do have iron condors inside the options playbook, which is the actual name of it. So the handbook might be a little bit different, getting a little confused if somebody did actually write an options handbook per se. But overall, yeah, the iron condor is a very popular strategy. So definitely would do you definitely can check out the iron condor at optionsplaybook.com, or obviously just buy the book via Amazon or whatever. But we go into great detail in the iron condor, like even trying to pick out strikes and give option guys tips on where we'd like to, where you want the market to land overall.
There you go. All right. Next up here, we got our members are discovering you here, Brian. They're discovering that you're available and they're coming at you here. We got Tony P. He says, hi, Mark and Brian. Thanks for the bonus. Yeah, Brian very ably decided to jump into the fire and answer some of your questions this way. So it was kind of a bonus one, last minute decision here, game time decision. So glad you folks are taking advantage of it. He says, thanks for the bonus, Brian and Mark. What do you guys think about a dynamic collar strategy? I haven't really heard much discussion about it. For example, collaring Apple with monthly expiring options and simply adjusting up and down when the price moves through a strike or then every 2 strikes. Over time, theoretically, we can add a lot of shares of Apple on the dips and keep ourselves protected. Also, secondarily, how far out do you go to sell puts to get into a stock? Again, Apple's at 138. If I like this price, do I sell 138 puts within a week or so, or do I go out 60 to 90 days? Thank you, Tony P. Well, a couple of different questions baked in there, Brian. First off, about what he terms a dynamic collar, which is effectively kind of just doing your, it sounds like more of your traditional zero cost collar, maybe in a weekly, or he says in the monthly. So lining something up there. And then if it doesn't go your way, you kind of just adjusting. And then B, kind of a corollary to that, selling puts to get into a name like Apple. Maybe we'll start with that. How do you normally go about when you're selling a put on a name like Apple with the intention to actually acquire the stock? How far out do you go? Are you doing it in the weeklies, or he asked 60 to 90 days? And then we can get into his dynamic collar discussion, Brian.
All right. So if I'm selling a put and I'm selling it cash secured, there's really no golden book of answers as to how far out I would want to go in time. And part of the reason why is that I'm cash secured. I kind of feel the same way as the opposite trade where I'm selling a call option. It has to do a little bit with the put premium. If I can go out a couple weeks in time, sell an at the money option contract, get some decent premium. I'm saying, $2 or $3, something that I feel comfortable with, then I would just sell the 2-week option contract. If there's no premium there, I might go out another week and look at it and see exactly how much protection that I would want to receive if I'm going to sell this put option. So the fact that it's a cash secured put and I want to buy the stock gives you a lot of flexibility. So also, you know that if I go out further in time, and so I guess let me say that I would lean towards a little bit nearer term if I could get that premium overall, because you do risk that if I sell this and the market runs down and I go out 60 days, as Tony mentioned, that market could come roaring back and I actually might not get put the stock. So if my forecast is that I'm going to be bullish on Apple going out 60 or 90 days, I probably just want to buy the stock, or just overall. If I'm selling the put and I'm thinking about a 1 week, 2 week, or maybe 3 week time frame, that has everything to do with the valuation that I'm getting for that put for that amount of time. Now, Apple in general, it's got some volatility, some predictability. I kind of like this stock to try to sell puts to buy more when it goes down. But in theory, most of the time, you're targeting a price to the downside, not necessarily selling the at-the-money option contract. And I'll just throw something out there for you, Tony. If you're pretty bullish on it, too, think about selling an in-the-money put option. And I've done that personally myself on a stock that I really wanted to buy. If there's some juice in that option contract, you want to make sure that you're going to get some time premium, but you go a little bit in the money and you kind of make it so that you are more likely to get put that stock and you sell that option contract too. I like that strategy also. But because you're cash secured, and you don't have to deal with the situation like we just talked about with time decay on a long call spread or a debit spread. You're just waiting to get put the stock. So look at the price. You feel comfortable with that price, sell the shortest term that you can receive a decent premium.
Yeah, I definitely agree with that. I mean, if he's looking to acquire the stock anyways, no reason to go out 60 to 90 days. Now you're getting to that same problem we were just talking about with Chad earlier, where you're kind of, you don't have time to adjust. You're kind of left twiddling your thumbs. You're not going to get the return you really want. You have to wait for a little bit, and you're also exposed to, if the worst happens, now you're stuck on that strike if the stock does start selling off. So go out in the weeklies, definitely, and get your position. I don't mind Brian's suggestion. If you do really want the stock, then closer to the fire, if not in the money strike, is probably the way to go. You get a little bit more juice, and if it does downturn a little bit, you do get the stock that you want. If you're concerned about an aggressive downturn, you can always turn it into a put spread, but you want the stock, so it's not that big of a concern. Now, Brian, here's another interesting flavor to his question, which is the dynamic collar here, as he puts it, which is effectively putting them on in the monthlies. I think if you want to do it dynamic, you maybe have to do it maybe more near dated, maybe in the weeklies, but putting on a collar in the monthlies, I'm guessing probably something along the lines of a zero cost collar, and then adjusting it when you break through the strikes. What are your thoughts on that, sir?
All right. Now, that's obviously a very active strategy. I have not seen a lot of people, as far as our clients, that actually do that, where you're trying to move that collar dynamically when it goes through the strike options. It's not a very popular strategy. It doesn't mean that it is a bad strategy overall, but it does take a lot of work if you want to try to do those type of trades. And then you have to have a plan. And the biggest thing that you do with that plan is you stick to the plan. If you're going to try a dynamic collar strategy and it gets to your strike, you got to adjust it. Now, that might sound simple overall, but I'll tell you, when you're got real money in and that happens, it's a real tough decision as to it's really hard to sometimes just pull that trigger, even though you should. It's sometimes just kind of tough to do that. So if you're doing dynamic collar strategies, it's a lot of work for I don't know. I don't know how much more upside could be gained by continuing to roll this collar strategy. With that said, commissions have came down quite a bit, but I definitely wouldn't want to do this in something that had wide bid-ask spreads. That would be an issue. So you'd want to have a very liquid stock like Apple, which we just got done talking about. I don't want to do this even in a stock like Walmart overall. Walmart's kind of got beaten up recently relative to a lot of the other stocks in that space. But bid-ask spreads are a little bit wider in Walmart as opposed to Apple. They just don't quite get the volume. So if I'm doing it, I got to be very specific on the underlying that I'm trading. I want to be able to get in and get out, and I want to make a plan and stick to that plan.
Yeah, obviously the caveat here, Tony, if you're going to do a collar, you have to have the underlying first. That's what you're collaring. So I'm assuming that's why you asked about selling the puts on Apple. You want to use that to get into Apple. So then, a more aggressive strategy at the money, maybe in the money put. Then you do get the underlying. Then you can decide going forward if you do want to do this dynamic collar strategy. I would encourage you to look into maybe some of the weeklies. My traditional collar strategy is not this. I mean, we talked about it. Just listen to the advisor's option episode we just did yesterday. In fact, I think it's hitting the network maybe as we speak. So if you got to listen live yesterday, you heard it. But we talked about this. We talked about this, the optimal structure for a collar. And it is not this. It is not the, zero cost doing it in the weeklies or the monthlies. Matt from ORATS has a lot of back testing data on it. And the OIC did a big collar study probably about 5 to almost 10 years ago now when they first started it. So it's a little dated now. But they did a collar study starting on the Qs, and then they went across a wide variety of asset classes, commodities, you name it. They went all over the place to see how these collars worked and what the optimal structure was. And they found longer term on the puts, so roughly 6 months to insulate yourself from time decay, and then selling weekly on the, or sorry, not weekly. There really were no weeklies then, so that'd be another reason to update the study. But more selling a monthly call. I think the call is 5% out of the money. I don't remember how far out money they were going on the put strike. But that was kind of their optimal structure, and that worked out pretty well for them. Doing this dynamic stuff, it could work. I mean, that'd be interesting. I'd be curious to see how it works for you. But first, you have to get the stock. So use the puts if you want to get the stock. If you're super bullish on Apple, then you can decide dynamic call. You can also just go the route of, hey, if it blows through your strike, let the stock get called away or to the downside. Have that protect you, and then you can decide if you want to readjust there. But I'd be curious if you do end up doing this, how it works. But either way, I would encourage you to check out that study from the OIC. We have it linked in the show notes for our recent advisors option. Just go to optionseducation.org and type in collaring the Qs, I think it was called. And you can see all that data for yourself. There are more optimal ways to set up collars, even if they do require a little bit of outlay at the outset. And then, so fun stuff, interesting stuff, but we can keep going. We got more questions coming at you, Brian. We got Luigi, my boy Luigi, says, I've had some email correspondence with Brian, and I wanted to thank him for all of his help. Oh, you're a very nice guy, Brian. He says, I own the Options Playbook. He says the right name, by the way. He says, I own the Options Playbook, and I noticed that he has an inverted skip strike butterfly in the book, but not an inverted butterfly, and was curious as to why he left that out. I think it is referred to as a short butterfly. So, Brian, why do you love yourself the skip strike flies so much, and why did you leave out Luigi's favorite, the short butterflies?
Overall, I mean, the most honest answer is we ran out of room. So we had to pick the different strategies, because of the way that we set up the playbook. We wanted to be able to bind the book so that it lays flat on your desk. And bottom line is we were getting to a page limit. So that's one of the reasons why. Another reason why I would rather do a skip strike as opposed to the actual short butterfly is the same reason why I like to do a long butterfly. If I'm doing a long butterfly, I'm paying very little overall on a stock that I would want to do one on. And I have a lot of upside in general. Now, that upside usually has to happen closer to the expiration date, much like the long call debit spread that we were talking about, because there's a lot of time premium in there. But I didn't like that risk reward as much as if I'm doing it on a skip strike situation where I'm still trying to get that overall I still want that big movement overall, but I want to lean either bullish or lean bearish and give myself a little bit more upside if I'm doing that trade overall. So it's more about the risk reward. And then it also had to do with a page limitation inside the options playbook. I guess I could add it online if I really wanted to. So maybe I'll keep that in mind. So I appreciate that, my boy Luigi.
And Brian, why don't you have ratio iron condor swaps? That's what we all want in the book, sir.
All right, I'll let you write that one, Mark.
And there we go. I'll do that page myself. So there you go. Your email buddy there, my boy Luigi, chiming in. I do believe he's listening right now. Next up, we got Nichols. Nichols with a Z says, what is Brian looking at here from a broad index perspective? If he were bullish, would he go long the underlying by itself? Would he perhaps hedge it with a put or put spread? If so, how would he structure that? Or maybe is he a fan of buying SPY, calls, and verticals? And thanks for joining us live today. Well, thank you, Nichols, for listening in there. So Brian, yeah, if you're looking at something broad index, sounds like he likes SPY here. If you were bullish on such a thing right now, he wants to know how you would approach it. Would you go straight long the underlying? Would you put a put against it? Would you put a put spread against it? Would you go call or call vertical? How would you approach a long SPY type position right now?
Well, you're getting too complex here. Ideally, now, if you're listening live, tomorrow we're going to have a podcast that will be out that deals with the XLF. And it's not the SPY overall, but we talked about it on a lot of options playbook episodes as a FOMO trade, fear of missing out. Find an industry that you like. They may have earnings coming up like the financials overall, and you buy a deeper in the money call option, something with like an 80 delta. And that does limit your risk. And then you also go on out and structure it. So, for example, I would rather just, if I'm looking at the SPY calls and I want to go out till 2022 overall, I would like, you got very liquid option contracts, and that's real important. And that's one of the nice things about doing very liquid ETFs or even indexes overall. And so you go out, you need liquid option contracts if you want to trade longer term options. Why? Because the bid-ask spread, it doesn't kill you like it does on unliquid underlines, like individual stocks a lot of times overall. And so that's what we mentioned that in the XLF. And then you say to yourself, okay, I'm going to pay about 10 to 15% of the total cost to buy 100 shares of stock, but I don't want to lose that 10 or 15%. So I would come out and say, how can I manage my risk? Well, if you're buying an in-the-money option contract and the stock goes up, you gain delta, you gain shares of stock. The momentum benefits you, the acceleration benefits you to the upside. But if the underlying market goes down, this is the wonderful thing about delta, is that it goes down slower when it goes against you. So a lot of times I'll buy that 80 delta call, go out further in time, and if it comes down to my strike price, then I get out and I can manage my risk that way. I'm paying, let's say, well, as a matter of fact, I know what the numbers were. I was paying 12.5% for the XLF call option that went out to January of 2022. And then I do a little bit of math and say, well, if it comes down to my strike price, I'm going to get out and I'm looking to lose maybe 7 or 8% overall. That's going to be how I'm going to manage my risk. And I just want to have an alert set for when the stock gets to the strike. And then once again, if you got a plan, you got to stick to it. So how would I structure myself? I want to limit my risk by buying deeper in the money calls, giving myself something that will allow me to participate if the market does continue on up. But then I have a total plan if the market does go against me. I would rather do that than trying to sell a put spread along with my long stock or anything else, especially if I have liquid option contracts on the longer term situation, like you mentioned in the SPYs.
All right, Brian, that music means you've done an able job in the hot seat. You're now released. We won't keep him for too long. It's not an official pro Q&A. We won't get him in the full hour session. Plus, remember, he just did a whole full show before this, so we don't want to tie him up for too long here. But Brian, great stuff here as usual. If folks want to participate in future huddles, maybe they want to ask you questions about options playbook or anything else directly, where should they go? What should they do, sir?
Well, the easiest thing for them to do actually is to follow me on Twitter. And my handle is very simple. It's at Brian Overby, at my name. And we actually post all of our educational events. Whenever I'm doing something, I let you know about it in Twitter live. So usually right before or right after the event happens. So you can go in and listen. And then also you can email them to me at any questions that you may have at theoptionsguy@invest.ally.com. Thanks for coming, everyone. And hopefully we'll be able to see you soon and do another huddle in the near term. We need to do more of these, Mark.
We do indeed. Thanks to everybody who joined us live. If you join us live, you don't have to wait. You got it in your ear holes right now. If you're listening after the fact, you probably don't have to wait about a week or so to get your hands on this one. We kind of sprung it on Brian last minute, and he ably jumped into the fray. But of course, stay tuned the rest of the week. Tomorrow we got double dose of TWIFO and the option block coming at you, episode 2 Friday, volatility views. And for all of our pro members out there, options oddities following an hour or so after that, all the way into another week. Hard to believe, another month coming up on July tomorrow already. But another week, another month, another Education Wednesday, another episode of Options Playbook Radio.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.